We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Rubino, former Wall Street financial analyst and author or co-author of 5 books, including The Money Bubble, What to Do Before It Pops. Also now publishes on Substack at rubino.substack.com. John, thanks for joining me today.
Hey, Tom, great to see you again.
Absolutely, John. So I want to start by talking a little bit about the earnings for the gold miners. Obviously, the third quarter just wrapped up, and we're going to be getting, and we've already gotten some of the earnings reports for some of the miners. So how are earnings changing, and how are they turning the tide for the industry? And is it only, really relegated to the best run companies at this point?
Yeah, well, first, a little bit of background on that. One of the things that's been really disturbing in the precious metal space in the last couple of years is the fact that gold has been going up, but the gold mining stocks really haven't. They should go up twice as much as gold does in a bull market. That's normally how it works. And they haven't been doing that at all. They've been underperforming the metal for quite a while now. And so, people have been wondering why and thinking about what gold price it would be required to set a fire under the gold stocks. And gold itself has been going up for the last few years, but strongly in the last year. And in the second quarter of this year, the earnings that were announced basically in July and August, a lot of the gold miners did pretty well because they had big revenue increases because the price of the thing they were selling was way up. And the best run gold miners saw most of that revenue increase percolate down to earnings and cash flow. So they reported some really good numbers. And that has helped. Now, in the last few months, the gold and to an extent the silver miners have just kind of outperformed, for instance, the GLD physical gold ETF. So it's starting. The miners are starting to outperform gold. And now we've got third quarter earnings coming out. And since gold went up pretty dramatically during the third quarter, you got to expect the gold miners to report even better earnings than they did in the second quarter. Mm-hmm. And that means that the gold miners start popping up on the radar screens of momentum investors. If you're looking at earnings momentum, and you see somebody like Newmont, which is going to report probably dramatically higher cash flow and earnings, then suddenly, even if you don't care about mining, you care about the trajectory of the earnings of this company. And so that tends to attract generalist money, and that's part of what really sets off the gold miners during a gold bull market. So it's possible that in the third quarter, we'll start to see that in a reasonably big way, because one quarter is kind of a one-off thing, but when you've got 2 quarters with rising cash flow, that's a trend, and a lot of people will be interested in that. And then you get the momentum, the price momentum guys, where if the big, solid, well-run gold miners stocks start going up, that's a different radar screen, but possibly one with even more money than the earnings momentum guys. So then you get a lot of generalist money coming into what is still a very small, thinly traded sector, and that gives the big, solid gold miners a pop. And then by implication, that starts to percolate down to the mid-tiers and maybe even the explorers. And then you get the bull market that we've all been expected in precious metals. So third quarter earnings are a big part of that scenario. So we'll see how it plays out. But I think, that's kind of baked into the cake. There's not a lot that will prevent third quarter earnings from being pretty good this time around because the cost structure of most of the big miners, they're experiencing inflation. Their costs are going up. But in the third quarter, I don't think costs went up nearly as much as revenues will have for these guys. So we'll see expanding margins. So, and that's happening shortly. Sometime later in this month, we'll see this tsunami of earnings reports coming out. A lot of them will be gold miners. A lot of them will be pretty good. So here's hoping.
Mm-hmm. John, why do you think that they have languished gold's performance thus far?
Well, mining has gotten a lot harder than it used to be. And so it's a legitimate reason why gold and silver miners didn't outperform precious metals this time around, because their costs were up so much. Energy costs, though they're not up dramatically just lately, they've been up for the last few years. Wages are up dramatically in the mining space. There aren't just, not that many engineers are going into mining. And so as the older generation of gold and silver mine engineers starts to retire, they're not easy to replace, and you got to pay way up for serious talent. And then just wages are up in general, for everybody else besides the engineers, you still got to pay up. So miners are, and then there's geopolitics. A lot of countries are changing the terms under which they regulate and tax miners. And some other countries are flat out closing mines and nationalizing mines and things like that. Panama just closed down one of the biggest copper mines in the world. Mexico has been talking about banning open pit silver mining. They haven't done it, and hopefully they won't do it, but they've been talking about it. So that's the kind of thing that, first of all, scares mining investors, because you have this big problem that you didn't used to have that you've got to factor in. So risks are higher, and then earnings aren't growing quite as fast as they ought to, given the underlying metal price trends. So it's just a tougher business, and that means, as I said before, there's a price for gold that fixes that, that makes revenues so high that it just swamps cost increases on the operating side. And it looks like we're heading into that territory, but that miners haven't gone up before this is because the business just got much harder than it used to. So that there's some investing implications for that too. I don't know if this is where you'd like to segue into that, but we should keep that in mind for the rest of this talk.
Mm-hmm. Well, 2 points on what you just said there. I think I spoke on the show last week with another guest, and we went through that Mexico situation. And there's actually, I believe, the new president of Mexico, she took that off of her website, apparently, this hostility towards open pit mining. So that was an interesting development. I saw that on Twitter. And, the other thing I think is that there are so many other, shiny places to invest other than gold and gold miners that is attracting shareholder capital as well. I mean, when we look at the performance of, just the S&P or Nvidia or some of the cryptocurrencies, it's absolutely a more exciting and momentum filled place than the gold mining sector for the last, for a good amount of the last, let's say, decade.
Yeah, generalists, momentum investors have had a whole bunch of other things to look at besides gold miners in the last few years. And what that did was it led to an awful lot of overvalued sectors out there, because you look at the NASDAQ, basically the handful of big companies that dominate the NASDAQ are about as overvalued fundamentally as they've ever been. We're getting into dot-com bubble 1999 levels of valuation with a lot of these things. So their upside potential is limited, and their downside risk is outrageous at this point. If we have, let's see, what kind of a crisis would be a good example here? Let's say we get into a shooting war with Russia or something like that, which we're really on the verge of right now. That would spook the markets and lead to the overvalued stocks being sold off dramatically. And so you'd see a big crack in the leadership of the NASDAQ, and they would just tank. And that's the kind of risk you run when you buy momentum stocks at the peak of a bubble. So we're there now, and people have to learn that lesson over and over again, because bubbles are decades long or longer sometimes. So you get a whole new generation of investors coming in who have to learn the lesson that you don't want to buy the shiny bubble stocks at the very top of the cycle. And here's how you analyze a cycle to see if you're at the top, and so a new generation has to learn that lesson. They will learn it, something will happen to crack the equities bull market. And there's so many things out there that could do that. And precious metals miners ought to outperform when that's happening, because for two reasons. One is that they're cheap relative to their history, which you can't say for most of the tech sector. Mm-hmm. And the other is that money tends to flow into precious metals when people are stressed out and worried. And a lot of the things that might cause an equities bear market would just stress people out in general and cause capital flows into safe haven assets. So you could see gold hold its own or go up this time in the next equities bear market. Mm-hmm. And at the same time, the miners are doing pretty well operationally. And so they might have a good chance of outperforming the market in the next couple of years, even leaving aside the fact that they're doing so well operationally. Just, the fact that people want to own safe haven assets when they're most stressed and most worried. And it's highly likely that the next couple of years will be stressful and that people are going to be worried.
Mm-hmm. Well, I mean, we can cover some of those reasons in a little bit, but you and I were kind of discussing before we hit record here today about this idea of trading and or investor psychology. As you're kind of talking about these bubbles that are in this very high momentum phase, getting very peaky. I was mentioning this idea of never FOMOing in, and that being a really expensive lesson that I learned back in 2016. I got kind of lucky and ended up kind of recuperating some of my losses a couple of years later. But this idea of FOMOing in because you don't want to miss out, and also the idea of hubris when something that you did buy when you maybe held your nose or when others were fearful is going up and you think you're the smartest person in the room because of it. That's also another indicator. And so I feel like for myself, the lesson was act the exact opposite way that you feel at the time.
That's the hardest thing in the world to do. And it's also the best thing in the world to do. Like Rick Rule says, in precious metals especially, you can be either a contrarian investor, which is what you're describing, or you can be broke. There's no real middle ground or third option or anything. So you have to buy things like precious metals when they're hated. Mm-hmm. And then you sell them when everybody loves them, and basically with everything else too. You just you don't want to buy what everybody else is buying, because who's left to buy if everybody else has already bought? And that's how markets go. And the fact that bull markets make everybody feel like a genius who's in it, and when you feel like a genius, you're a lot less risk averse than you ought to be. And then you get burned and you have to learn that lesson. So everybody has to learn the lesson. And mm-hmm. Lots of people are set up for that lesson right now. And you can tell them that, but they just totally dismiss that advice because they're geniuses. And look how much money they've made. And, a big part of the market is that way now. After 10 years of a bull market, the majority of the traders on Wall Street have never seen a bear market. And you get that every single time. That's how cycles work, especially in a credit super cycle where the bubbles are relatively long and relatively extreme. You get a whole generation of people who just don't know anything else except buying the hot asset and being right and making tons of money and feeling like a genius. So they'll get burned, of course. And the people who bought undervalued, hated assets right now will do better because that's how it always works. And right now, the hated category, one of the hated categories, is precious metals miners. So I think there's a very good chance that 5 years from now, they will have done really well, and the people who are in them will be happy. But right now, it's kind of it's frustrating to miss out on all the FOMO money out there because, if you just bought NVIDIA 8 years ago or Bitcoin 15 years ago, that's all you had to do, or buy a house in California. There were one decision financial events out there that we could have done. We didn't do it because we're looking at gold and silver, but the payoff will come. It always does. And I think we're fairly close to it now based on a lot of momentum-y kinds of trends, because that's usually the definition of a bull market, when you get things like rising precious metals prices and rising profit margins for the guys mining precious metals, and we're there now. We're in that space that usually leads to much higher stock prices.
Well, unfortunately, we can't invest retrospectively. Otherwise we'd all be billionaires, right?
Yeah. Well, and if we knew then what we know now, we'd be doing a lot of other things too, much better than investing. So yeah, true. That doesn't work.
So, John, when we think about, let's say, the cyclicality of how these cycles play out, do you see buyouts coming for the sector if these earnings continue? And what are some of those developments?
Well, yeah, when you put a bunch of free cash in the hands of mining executives, they have several things they can do with it, right? They can pay dividends to their stockholders, they can buy back their own shares, or they can expand. And the way it usually works is, coming out of hard times, the guys running the bigger gold miners, they still remember how dumb they felt because of the last acquisition they did at the very peak of the last market. So they're cautious. They reward their shareholders by buying back stock and raising dividends, and that feels good. Everybody's happy, but then more cash flow comes in. And more cash flow comes in. And some of the other big guys out there make some front page news acquisitions and look like they're building an empire, and their stock goes up because everybody thinks being aggressive is yeah. And so everybody starts piling in, because at that point you get the FOMO thing going. And then you get kind of bidding wars and a feeding frenzy in which the big guys buy out the little guys. We're nowhere near there yet, but it does feel like it's beginning. Cisco Mining just got bought out, Gatos Silver and Silvercrest Metals, all in the last couple of months, and the last two in the last few weeks. And the premiums over the stock price varied. Gatos was a pretty big one, I think, and Silvercrest was a modest premium. So it's not a buying frenzy yet. There's no kind of panic out there. But this is the way it begins. So let gold and silver go up some more. Let cash flows rise at Newmont and Barrick and Agnico Eagle, and let a few more acquisitions take place. And that the floodgates will open, and there will be a lot more acquisitions, and that's good news, bad news for you and I as investors in, say, exploration companies, because when you buy an exploration company, you know that half of the ones you're buying are going to go bankrupt. So you need a big winner or two. You need some 10 baggers to save you from the losers that you're investing in. And if the big guys are coming in and buying out the best run, most promising exploration companies for 50% premiums over the last 3 weeks average stock price, that's nowhere near a 10 bagger, but that's also how these things start. 10 baggers come at the end of the process, when pretty much anything has a market value, and there's tons of money to be thrown at the sector.
When we're in that mania phase. Yeah,
because the generalist money starts flowing in, first of all, because they see a few buyouts, and that's another trend, so they want to ride that trend. So they start bidding up these little things that can't be valued in any reasonable way. So there's no like PE ratio or anything with a small junior miner or an exploration company. So the generalist money doesn't know how to tell whether it's getting a good deal or not. So it doesn't bother trying. It just buys things with the name silver or gold in it. Mm-hmm. And so that's when those things start rising. So the good with the bad go up. You might get 10 baggers in companies that are never going to succeed, but it's got a really nice sounding name with silver in it or something like that. And so you combine that with the big possible acquirers getting more and more cash flow from higher metal prices. And then you've got the makings for a serious bull market in what is a very thinly traded, low cap market, where even a little bit of cash sends whatever it's chasing through the roof. That's the way that normally goes. And so that's where the early investors in the best run explorers and developers and juniors tend to make a lot of their money in the last couple of years of that process, right? That's when you get the parabolic moves. So you have to be careful not to take profits too soon. But of course, you also don't want to stick around and be round tripped. So it's never not stressful. You lose sleep no matter where you are in the cycle, because if they're going down, that's brutal. And if they're starting to go up, that's exciting. So you got to wake up with the stock market, which on the West Coast is pretty early.
Mm-hmm.
And if they're just rocking, if you're getting all kinds of things bought out, then maybe you don't even sleep at all because you can still watch things on the foreign markets and everything. So it's never a restful situation to be investing in a sector like this. But the 2 years in which you're a genius basically solidifies that personality trait in you forever. You have 2 amazing years in junior minors, and then you'll stay in for the next 8 years of just a slog. Unless you're one of the really good ones who have total control over your emotions, and I aspire to that. This is probably my last big cycle in precious metals, and I want to get one right completely. So that's my goal this time around, is actually to time things that in a way that in retrospect looks smart instead of stupid.
So what do you think are a couple pieces that you're keeping in mind in order to try to achieve that, John?
Well, the behavior of the bigger companies is something that we got to watch, because they're, if their cash flow is just rocking, then there will be acquisitions. And so we don't want to get depressed over some little miner that you own that's having trouble getting financing and doing a dilutive share offering or something like that right now, because over the next couple of years, there will be capital flowing in and financing will get easier. So they have a chance to do, a share offering on favorable terms or something at some point. So, that's one of the things that you want to watch for. If cash is coming into the sector, then that papers over lots of issues, and you want to ride that. You want to be there for the duration of the upward sloping cash flow trend. And then otherwise, to the extent that, if you're not a good judge of quality in this space, now is the time to educate yourself in a hurry and learn what the characteristics of a winning explorer or junior miner are. And it's fairly basic. It's another one of those things where you have to control your emotions, because sometimes the crappy ones go up even more than the high quality ones just because of their names. But you want to focus on quality at every part of the cycle here. And now isn't the most crucial time to focus on quality, because that's later on when financing starts to get tight again. You want the ones that are going to survive, but you still want the best names, the best run juniors, let's say. And the basics there are, has the management team been there and done this before? And that's a big plus if they have. Are they in a really favorable jurisdiction that's not just going to expropriate them, or a rebel army is not going to come over the hill and just kill everybody at your mine? That's not an exaggeration for some parts of the world. So good jurisdiction, excellent experienced mining. And then Rick Roll stresses this in a lot of his interviews, which is size. If you're looking at an explorer, the bigger the deposit, the better, because any mine has the same startup problems and the same risks. But a big one, when it succeeds, makes you a ton of money. And a small one, when it succeeds, with the same risk profile, makes you less money. So other things being equal, go for size. And then consistency of results. If you're looking at drill results or something like that, but there's a few companies out there that just consistently have excellent drill results. And, Great Bear Resources, which is the stock that everybody in this space wants to replicate, or Snowline, which keeps finding these, 500 gram meter intersections starting from the surface over and over again. That's another one where you want stuff like that. Or Cisco Mining, which got bought out recently, had pages of drill results that were mostly excellent. But it wasn't just 3 or 4. It was 200 of those things that were like company maker drill results, and they just kept finding them and finding them. So they were an obvious takeover candidate because they had pretty well defined their resource by that time. And it was a really impressive resource based on all those drill results. So you want that. You don't want, okay, 3 or 4 holes were dry holes, and then we had this one that was 90 gram meters. That's still might work out, but it's not obvious. And you want the obvious ones because there are obvious ones out there. One that I missed was Vizsla Silver. That they looked good, and promising, but very early stage a year ago. And I looked at them for my Substack recommended list and thought, well, too early. We don't know for sure about these guys. And in the ensuing year, they crushed it. They just had excellent drill results. And now the stock has, depending on where you start, but it's either tripled or doubled from their lows of the last few years. And so now, I'm wrestling with, well, is it too late? Because which is another lesson in this space is that don't buy after the pop, because these stocks have a really common pattern is they report some really good news and then they just spike. They're the shiny new thing for about a week. And that creates a whole bunch of people who have profits to take and they don't want to be round tripped. So they sell a little bit. That moves the stock down. Then they get the opposite of FOMO, and everybody starts to panic because they don't want to be round trip for sure. And then the stock goes back down to where it was before the pop, except that the company is higher quality because of that report that set off the pop. And so that's a cycle that you can play with your buying. In other words, you should always be kind of dollar cost averaging, but you time your dollar cost averaging to not have you buy much at a pop and then buy in a little more strongly after it retraces, as long as there's no new bad news in the ensuing months. And that saves you a lot of grief because so many of these things just have huge runs and they look like they're just going to take the world by storm and they're going to be a 10-bagger guaranteed. And then they go right back down to where they were 6 months before. So pay more attention to the results that a company is generating than to what its stock price is doing in the moment. And that's very hard to do because, if something takes off, you think, wow, I might never have a chance to buy it at this price again. And you probably will have a chance to buy it at that price again and much lower. So again, emotionally hard, but the kind of thing that you need to learn how to do. Mm-hmm. Or I need to learn how to do.
I think all of us can use at least a refresher on that lesson, John. Yeah. Are buyouts typically always a good thing for shareholders?
No. Early on, they're not. I mean, look at Silvercrest Metals. They had a nice run in the last couple of years. So people who owned it now have like 100% gain built in and everything. But man, they built their mine on time and under budget. They started generating free cash flow right away once they started producing. They paid off all their debt almost immediately. They paid their back taxes and they were generating cash. So their cash pile was going to rise, which gave them all kinds of flexibility. So they could have been a nice, steady company that generated some cash flow, raised their dividends, and just went up year after year. And they could have gained much more than the buyout premium over the recent share price. And weird thing about it was Core, the company that bought them for their cash and for their cash flow, which isn't normally. They wanted to, the acquirer wanted to improve its finances by making this acquisition, which is just not at all how it normally works. So, don't want to laugh at 100% gain or anything, but this could have been a nice holding for however many more years. They could have used their cash flow to buy out some of their smaller competitors And they could have been kind of a roll-up company who, build a multiple mine portfolio of good-looking young companies and finance them with the main mine's cash flow. It could have been an interesting company going forward. So sorry to have missed that. So no, an acquisition is not always a good thing, and it's frequently not a good thing if you were hoping for a 10-bagger. So that's just the nature of this space. The early ones are at smaller premiums. The later ones are the ones who make up for the fact that the early ones were at small premiums.
John, what do you think are the more important factors to be looking at and paying attention to and really researching to try to understand within this sector and within, gold and silver generally? Do you think that, fundamental setups or technical indicators are more important to how the metals markets move?
Well, I've never paid a whole lot of attention to technical indicators in precious metals. It's fun to watch, like, oh, is 3,000 going to be the resistance for gold? That's interesting. But if you think gold is a $10,000 an ounce asset ultimately, then $3,000 an ounce really doesn't matter compared to 3,500 or 2,500 or whatever. It's still going way up when the financial system just kind of blows up like it's going to. And the seasonality thing is actually a pretty reliable, technical-ish indicator for gold and silver, which I always get wrong because by the end of 1 6-month stretch, I just extrapolate that out into the future and think, okay, seasonality is not going to matter this time. I'm going to do what it's been doing for the last 6 months, and usually wrong. So a technical indicator is only good if you follow it and do what it says to do. So now, I think the fundamentals are so much more important in precious metals because, gold and silver as monetary metals don't actually do anything. They just sit there. They are inert, and that's their value. They're rare, and they'll be around for 1,000 years if you just let them sit in an undisturbed place. And that makes them good stores of value because they're forms of money that are just going to be there as long as you want them to be there. And we're in a world of fiat currencies that are just evaporating now. The fiat currencies are just based on our faith in governments, and people are losing faith in their governments at an accelerating rate. You look at the U.S. right now, and God, we can go back to, for instance, the Second Iraq War, when they lied to us about Saddam Hussein's weapons of mass destruction. We found out that was a lie, cost us several $1 trillion to prosecute that war and gained us basically nothing. And then comes a bunch of the political stuff where we weaponize the criminal justice system in the U.S. And then the pandemic stuff where we basically set the pharmaceutical companies loose to feast on people who didn't know not to trust what was going on. This has gone on, and people are losing faith in the big systems. And the biggest system in the global financial part of the world is money. So once you don't trust anything else about the government, you don't trust your money anymore either. And that's the way it's happening across the world. And so you're seeing the value of fiat currencies decline at an accelerating rate. And that's paradise for precious metals. Go back to the 1970s, although, very few people are old enough to, or young enough, which is old enough, yeah, to remember the 1970s clearly. But that was a time when we lost faith.
I think there's a bit of a sweet spot there about being young enough and old enough.
Yeah. But, back then, we thought that communism was the future, or a lot of people did. And then the U.S., which was, a quasi-capitalist system back then, that we would become more and more like the Soviet Union. We'd end up some kind of a hybrid thing where the government was in control of a big part of the economy. We were kind of we just come off losing the Vietnam War. And so we didn't trust ourselves militarily anymore. And then inflation started to pick up because we were trying to finance well, we were financing a military budget that was higher than it used to be because of the Vietnam War and the Great Society social programs at once. And so we were creating lots of new currency, and interest rates started to go up and inflation started to go up. And so we had a big financial crisis that was basically a crisis of confidence in our ability to manage our currency. So you had double-digit inflation. You had like 18% home mortgages back then. It was crazier than anything people who haven't lived through it can really conceive of. And we're entering a period of time like that again, only much worse. You know, the numbers are so much worse than they were back then. And the mistakes we're making are vastly more serious than they were back then. I mean, we're blundering into World War III on three different fronts right now. And there's no point in it. There's no reason for us to be doing that. We're just doing it because we're incompetent and greedy and vicious. You know, we're just making mistakes like really that we've never made before. And people get it, you know, because they've lied to us in so many different ways that you've got groups of people in the US, especially, who, okay, they got lied to about this one thing. They weren't paying attention to the other things, but that one thing was enough to make them cynical. And then other groups of people were lied to in other ways and so on. But you add them all up and you've got a critical mass of people who don't trust the government to take care of them anymore and to be honest and be competent. And that is, that's a monetary catastrophe when that happens. You end up with something like the Austrian School of Economics crack-up boom, when people just give up on the currency. You know, when they get it, when they get some money, they buy real stuff. They buy farmland, they buy oil wells, they buy gold and silver. That pushes the price of those things up, which manifests as inflation, and the currency's value starts to fall in a disorderly way. And we're creating the conditions for that. And that's brilliant for gold and silver. You know, people pile into real money when unreal money starts to finally fail. And I think this is clearly the decade when it happens. But the question is, will it be the 3 or 4 years when it happens?
Mm-hmm. Well, I think, an example of exactly what you're talking about that kind of crack up boom type scenario is also this wage price spiral. You know, you brought up to me again before we started the show here, the idea that the dock workers in, I think, California or whatever, got something like a 63% raise. And, that just ends up kind of backfeeding and being another source of inflation again, right?
Oh, yeah, that's a very big part of the story now. And it plays back to the 1970s. Analogy, because in the 1970s there were labor strikes and labor unions were getting cost of living increases, which kind of embedded inflation in the system. This time around, basically, we're coming off of a time that ran from the 1980s until just lately, when globalization was a big trend, when we basically told the corporations, yeah, go ahead and move your factories to China, fire your unionized workers here, feast on that lower wage level over there, and then pay your CEO a gigantic bonus for being super efficient, And so we crush labor unions in the US. We created this whole generation of people, basically high school educated men who used to make middle class money working on a GM assembly line or something like that, and then they got kicked out of that and basically abandoned to Walmart and McDonald's, where they basically had nothing offered to them that would allow them to raise a family. So we basically sacrificed a whole generation of people, and corporations made more and more money. The proportion of corporate profits that went to the corporations rose relative to the amount that went to wages. So the rich got much, much richer. The middle class was basically wiped out in a lot of cases, and the poor got much, much poorer. So we created this society of haves and have-nots that is inherently unstable. And now the pendulum is swinging back the other way because populist politicians are winning basically everywhere. And populism basically says, populism isn't an actual economic policy philosophy. It's basically a political strategy, which says, look, you're being screwed over by a handful of rich people. I'll go get what was stolen from you and give it back to you. Okay. And so it can be left wing populism or right wing populism. Bernie Sanders or Donald Trump. Either one fits that mold, and they both are generating a lot of interest politically now. So we're now, because of that trend, we're bringing back factories, we're reshoring. That's the trend, or the term for the trend. We're bringing back factories to the US, and we're trying to build stuff here. And that hands the power back to labor unions and to workers in general, who now want, they want their life back. They want middle class wage for doing the work that they do. And so strikes work now because corporations don't have the option of firing all their workers and going to Mexico or China, because that's not politically palatable anymore. So yeah, workers are now able to strike for big wage increases. And that's great in one sense, because these guys were really screwed over for decades, for basically an entire adult lifetime, for people who came of age in the 1980s. And they deserve more than they got. So their kids are getting more now. But it also creates something called wage inflation, which scares the hell out of the Federal Reserve, and when wages are going up at double-digit rates, like for the dock workers, that's going to be a 10% increase for 6 straight years, and you want a 2% inflation rate. If you're the Fed, you got to tighten in the face of that. So that's going to lead to more pressure on the Fed to tighten, which we can't have anymore, because if interest rates go up, all the debt that we took on becomes ruinously expensive. So higher interest rates bankrupt everybody in sight, but lower interest rates lead to dramatically higher inflation, which we saw in 2022, which is a catastrophe. And so we're at the place now where there is no solution. The fiat currencies of the world led to the inevitable massive debt mountain everywhere. And now that experiment is coming to an end, and so we have no solution except a choice of crises, one, a deflationary or an inflationary crisis, and that's coming. And the whole wage inflation might be one of the things that sets it off, because it's something that's very understandable for economists who don't think like rising stock prices or rising house prices constitute inflation. But they do think that rising wages are inflationary, and so they're liable to react to that. So we'll see.
John, one of the other pieces that I wanted to discuss with you here is, kind of another one of these fundamental side drivers. There was news out of Russia recently that they're maybe refreshing or renewing their strategic precious metals reserve fund with silver. So what are the nuances to understand there?
Yeah, Russia has a fund in which it buys gold and platinum and palladium, but it hasn't bought silver up till now. And now they've announced that they're buying silver, which is, other things being equal. I mean, there's 50 things you can point to that are great for silver, but this is yet another one. And Russia, I mean, they're selling a lot of oil to India and China, so they have cash flow. And so they potentially have the ability to direct a lot of cash flow in anywhere they want to. And if they put a reasonable amount of it into silver at a time when silver is already in deficit, the world's mines aren't producing enough silver to satisfy the world's silver users. And if we have one more potentially big buyer of silver come into the market out there, that just makes the market that much tighter. And it puts more upward pressure on silver, which is a deficit market, very thinly traded, very small in any event. So it doesn't take much to move it. So we'll see. I mean, we'll get some sense of the dollar/ruble idea of what Russia's doing here pretty soon, and we'll know if it's significant. And if it is, then it's something that might want to be listed along with solar power and military missile demand and investment demand and everything in on the list of things that move the silver market. So we'll see. But it's, other things being equal, a very good thing.
Absolutely. John, I know we're coming up against time here, but is there anything that you'd like to leave our listeners to think about before we wrap up here?
Yeah, that most of what we talked about here, all the gloom and doomy stuff, is basically an investment thesis. So don't curl up in a ball and think the world is ending. Although, World War III, it might be. But focus instead on how you can exploit it, because that's something that makes you happy. And worrying about how we get here is really depressing. And we shouldn't walk around like that. We should walk around with positive plans, because that's much healthier. And the investment theses that flow from the gloom and doomy stuff now are, epic, really life changing. And we can be among those people if we do it right.
Absolutely. John, I want to thank you for sharing your perspective and the lessons that you've learned over the years with us today. Of course, for anybody that wants to read more of John's work, that's all available at rubino.substack.com. John, thanks for joining me today. Really appreciate your time.
Thanks, Tom. Enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.